in our daily today.
Sorry.
And also the how to appreciate it into practice. So this is, and you can page 4. Was we continue a bit to know what is financial management. It calls our attention to the recognition that the demands for funds is always more than like makes financial management. So it reminds that whenever we deal with money or infrastructures, when we need to make a project, we need to be realistic what we are looking for, because the needs for money is always higher than the availability. So we may look to build a school or a convent, yeah, but you have to be realistic. Where do I because we make a plan, we establish, but then we have to be aware that maybe the money that is needed is maybe it's going to be above our possibilities. So to be aware that whatever we are planning, we have to see if the money that we seek or we have it available is really enough to make it realistic. Then on page, what's the importance and the efficiency for the use of resources. So it's to make sure that the resources like the funds, money, is well and I mean is used well, and it fulfills its purpose for the in order for the donors, the stakeholders keep simple transparency, and also it helps that the good accountability to stakeholders also bring honor from the institution or from the entity before them, because when we are transparent, when we give good reports, so the funds and the conditions. In page 6, it says that in order to or sponsor a competition and to help spread for them the sustainability. So it's a bit completing what was said in the first 3 pages, that by providing good reporting of management and the resources of being in conformity with its obligations, so it helps keeping being financed. So the more we are transparent, the more we have the statements at hand and clear. So this financial health is always having into account the feasibility of what we have at hand.
Sorry, Brother Paulo, can you
Yes.
close to the microphone? Sometimes the voice is breaking.
Okay, to close mine. Okay.
Okay. All right. Thank you.
Let's see if I.
Brother Paulo?
Yes.
Okay.
I've got it. It was off. Okay. So then the ownership and accountability concept, the ownership versus management, in order to comply with owner requirements from financial management, ensure that the organization.
Your voice is not clear, brother.
Is it from the?
Now it's good.
Oh, it's good. Okay. So, the stewardship and accountability concept of ownership versus management, in order to comply with donor requirements, and sound financial management ensure that the organization's funds are safeguarded and used for the intended purpose. So it implies that we need to care for the protect of the sources of the organization, to keep it in reinforcing the idea also of mentioned above, so that the resources, that whatever we get, it is well used, well managed, proper reporting, proper, not just the report, I mean keeping the receipts or whatever identifies the expenses or incomes, and also to provide a reporting to the donors. On page 8, it says that to ensure there is adequate liquidity for the organization, to ensure wise investments as a basis for making decisions, as a basis for evaluation. So what it requires here is the ability to meet the daily run of the institution needs. So that whatever we invest, whatever fund that we get, and what our premises, buildings or whatever, so it should also be in view of keeping it running. So it's not just something that we have and then there's no profit, there is no investment, but this also should be in line of investing, of keeping innovating and making it sustainable. Page 9, it is that it is effective and efficient. So use of for the achievement of organization. The finance is an important part of management, and it is one of the key resources in an organization. Money is so money is, of course, it is indispensable factor that keeps that organization moves forward by strengthening it. And so also in this line, when our sponsors see that when we ask money for them to build a building or to buy maybe a machinery or a car, whatever. So if they see that this we keep it well, and it is in benefit of benefit, but also in view of others, so they keep financing and recognizing that this liquidity that what comes from there, it gives life and sustainability to a center or to any entity. Page 10, definition. Utilization and control in order to so the financial management of an institution is looking for money and funds and they use it efficiently. They have to also to follow policies, procedures that are required internally, but also required by the stakeholders, the sponsors. And chances need to be seen. Then, of course, we have to also to ask ourselves: are we improving? Are we making profits? And so, also this in regards to the external stakeholders, or if, for example, if we have a school, we have students. Also, we have to see if when the parents they pay school fees, or for example, in our community, when we make our annual budget, are we well using well the money that has been granted? Have we planned accordingly, or how was it done? And then now comes the bit 11. I think the main some of the pillars of the financial management, which is planning, that is to make the best use of the money or resources, organizing to invest in view of productivity, controlling, making sure it is well spent, example, yeah, as I said, so if we invest, you have to see if the money is well spent, monitoring to avoid mismanagement. Maybe maybe some people can misuse, spend money but don't give a proper reporting, and so this monitoring also helps to achieve the objectives of what it was planned. On page 12, also there is the 3 key elements of the process of financial management. Which one is the first one is the financial planning and budgeting. So
We can't hear you, brother.
maybe I went a bit aside. Sorry. So I will say that the financial planning or budgeting are the management needs to ensure that enough funds are available at the right time to meet the needs of the organization as for paying salaries, wages, services, and expenses. So the financial planning is and the budgeting for so the important thing is that when we establish the project or a planning, so we need what we need to foresee that at least the basic that other services and expenses also have money to cover them. Then the so part of which aims to ensure that the project is meeting its objectives. Financial control addresses questions as: are the assets being used efficiently? Are the organization's assets secure? Do managers act in the best interest of stakeholders and in accordance with established policies? Is there conflict of interest? So policies and procedures are means to monitor and control the direction or allocations and use of financial resources. So as I think maybe some of us, like sometimes it's difficult to understand what are assets. So I try to also to elaborate something to help. So assets is anything that has value and that belongs to the institution. Or then there are different types of assets. There are current and non-current assets. Current assets is cash, short-term investments, accounts receivable. If we pay something on the, if we rent something, then we sold something, but we have to receive it later on. Non-current assets is a company's long-term investment that have a useful life of more than one year and cannot easily be converted to cash. It's like land and heavy equipment. Then also then other are tangible and intangible assets. Tangible assets are physical of physical substance like land, vehicles, furniture, machinery, equipment, securities like stock. And intangible is a non-monetary asset that cannot be seen or touched. Computer, software, licenses, trademarkers, films, copyrights. And then also we have operating and non-operating assets. Operating assets are those acquired for use in the conduct of ongoing operations of business. In other words, assets need to generate revenue. So there is cash, are accounts receivable, money owed to a company by its debtors, are investments, are vehicles, furniture, and non-operating assets, assets that aren't used to make money, like land, which is a fixed asset that isn't being used, or vacant buildings. Sometimes we may have buildings, but we are not making use of them, so they are non-operating assets. outdated machinery, so they are no longer in use, or idle equipment. So this one to understand use of them to make more profit of them. Then the page 14, it says also control occurs when systems, procedures, and policies are established to make sure that the financial resources of an organization are being properly handled. So it also helps to how we are looking. And then on page 15, another key aspect of financial decision making. The financial manager helps management decide what investments to undertake and how they will be financed, bearing in mind the available sources of funds and the related costs of obtaining finances. So one thing you have to see is to evaluate current financial conditions, state the financial goal in order to develop an action plan. So it draws on analysis of estimates, like making a budget, then investments, options, and number of financial documents that includes cash flow statements, balance sheets, and profit and loss statement. So the key aspects are related and based many times on these three documents. Yeah, the cash flow, so what is the income and the expenditures, then the balance sheet that shows what are the assets, what are the liabilities, and also the profit and loss to compare that what comes in and the expenditure. So to help to see how we are, so that if we are in a loss or we are in making profit. Then page 16, the role of the project financial officer. So in sourcing and utilization funds, cash flow management, planning and budgeting, investments, maximizing returns, monitoring and cost control, timely financial reporting. So the role of the project financial officer is, of course, is sourcing and utilization of funds. So is when we see that maybe our institution, our dioceses or our schools, our homes don't have maybe funds enough for maintenance, so we need to look around for sponsors and donors. And then the cash flow management is the process of understanding or controlling of movement of cash and non-cash moving in and out of business. So that, yeah. And then also planning and budgeting, planning a framework for business and budgeting is how the plan will be carried out. So then so the role is also to in this sourcing of funds, of planning, of investing, has to be so done in this framework, which is then we plan at the end or at the beginning of the financial year, and then we can revise it monthly, quarterly, and annually to see if what we planned, the budget we made is being kept. Are we fulfilling what we thought, what we had planned, or are we out already of the funds, running out of short of funds? And then investments, maximizing returns, so as to generate more sales and revenues to raise the prices. To see if you can increase sales, for example, if you have for example, a repository or other things, to increase sales and revenues without increasing our costs. or only increase the costs enough to still provide a net gain in profits. And then monitoring and control, it involves collecting information and analyzing data gathered from the project and using these findings to make changes, or these findings to make changes. The cost control, it is a budgeting process to identify and reduce business expenses to increase profits. Timely financial reporting, it is a careful year-long planning and monitoring in order to meet needs and decision makers. So this is very important elements that maybe as we go on along, maybe we'll come to understand a bit better. So then another on page 17, aspects in managing finances. Because incomes should always exceed expenses. Retain part of the past in the reserve fund. Ensuring accurate financial record keeping, planning and budgeting, comparing actual to budgets, managing risk insurances, and cost reducing measures. So first, what is important is always that when we establish the project or investment, to make sure that the money that is invested and what as is go along, that we always have money to pay the salaries and the daily expenses, and try to avoid as much as possible in insolvency or bankruptcy. And then the surplus is the amount left over when requirements have been met, and open a reserve fund in view of gain interest. So I think many of us do it. So in our institution, like in our institution, we have some funds that is for some money that it becomes a surplus of annual financial year. So that money or part of it, we can take it apart and open a different account, so that being in a fixed deposit, so it can always get interest. So it kept it after some time, it can help meeting the needs if we see that here and there the money is not enough to keep running the institution or the projects. And then accurate financial recording, the importance of recording all incomes and expenditures, being it cash or bank money. As we said in our first workshop, that also receipts, cash slips, invoices, or any document related to movement of money and any type of assets are to be kept and provided to substantiate the income and expenses stated in the report. Because sometimes, of course, we are busy, we are running many things, and if we miss one cash slip or one invoice, and then when we come to register, of course, for example, if we draw money from the bank and it should come to cash, we make an expense. Now, if we don't have a receipt or a cash slip or something proving that, so then we'll be in trouble also, first before our superiors, and then or the bursar, but also in front of the donors who trusted us, or who believed in us that we are going to spend the money well. Then planning and budgeting, it is a framework which helps the management to develop a plan of action, and budgeting is an expression of these plans, expresses it either physical or financial terms. And then also comparing actual to budgets, it is a comparison of two or more sets of data. It is the difference between actual amounts and what was planned or budgeted. So as I said before, for example, we can do it monthly, quarterly, or after every 6 months, or at the end of the year. So it's good that from time to time we check the cash flows and compare it to the budget to see if we are keeping on the right side of the framework or maybe or if we spend here more here and less there, so we can justify why it happened, and also to avoid that we overlook or go out of what was planned. And then also managing risks insurance. So when we have big structures or big investments like buildings, cars, or machinery, it's always good to have to insure these sources, because if it can happen theft, or maybe a fire breaks in, then everything is reducing to nothing. Then we lose, and we are not compensated somehow for what we have acquired. Then cost reduction measures. It may include laying off employees, reducing employees' pay, closing facilities, moving to less expensive building or area, or any other service. So also it helps to see if, for example, if you have too many employees, no, we are not able to pay them, so maybe we have to reduce their number, or if the building we are having now is becoming too expensive, maybe to look for another more maybe cheaper or more feasible. On the page 18, I'm not still in the aspects of managing finances. Also, the managing debtors and creditors by decisions or person, dealing with idle, matching long-term investments to long-term financing. Some managing debtors and creditors. Okay, for I don't know if for us, but for many institutions or organizations, they are the key to business success. So debtors are those who owe you money, and if you are that costs your business and it cannot survive. Creditors, those to whom you owe money, for example, you buy something and they don't pay, but however, non-payment of business bills on time may cost business additional costs in terms of interest. So if you delay paying your debts, then maybe you are penalized, or yeah. So there is no gain. Then on page 15, versus expenses, ensure that your total covers expenses. Organizations which consistently make losses will close down. Look for ways to increase your income and cut costs. So this is also an important aspect. So that, because for example, if we have an investment, for example, we have a school, we have students, but their number is reducing. I mean, the number is reducing, but we have to pay the teachers, we have to pay the staff. So that, of course, if the income is becoming less than the expense, so something is wrong. So we need to look for means to keep the school running, and to avoid it to close down. If not, will happen to a loss of investment and infrastructures. Then cost cut measures. Cutting this. What is page now? Yeah. So we also need to creative expenses. For the let us say call center as the groups coming in. So if we buy meat from a shop, maybe we pay more than if you go maybe to a butchery and we can buy a better quantity. So also it helps to have discounts on what we buy. Yeah, so we have this and see how we can reduce, yeah, the expenses with the income that we get. Also, making risks like insurance to unexpected events can lead to a major financial loss or closure, and the reducing of personnel in our institutions and of the school, or for example, even in our congregations, if the number is, because if we have a cook, we pay the same for one person as for 10. So but if it's 10, okay, the money, if divided by 10, becomes less, but it's only one person, the value of that salary becomes more expensive. So then, of course, the importance of insurance policies to prevent these situations, and also embarrassment in view of our infrastructures. So it keeps possibilities of fire and burglary insurance, also personnel accident insurance. But it's important that our workers are insured, that if any accident takes place, we quickly identify this incident and we report it to the proper department. Also, the medical insurance, when we go for treatment, it doesn't increase on the institution fee and also on the patient. Cashing insurance. Yeah, that page. Sorry, because it's a page 22. Yeah. And then also the vehicles is a burglary happens, or a fire. So there are different insurances that we need to see if they are applicable in our places, and if we don't have, it is advisable that we look for it and apply it as much as possible. On page 23, also keeping on key decisions by financial manager, investment decisions. So what assets should the organization hold? This determines the left-hand side. Okay, so this it is a bit. I don't know if you are familiar with what we call the balance sheet. So one side it is we have the current assets, and the other side we have the liabilities. So then you need to fill the proper spaces assigned to it, and so that we see how we are. So it contains the current cash assets, the current bank assets, medium and long-term credits, investments, and fixed assets. Maybe we can maybe of maybe one of our institutions and to see how it looks like. On page 20.
There's a red sign there.
The investment decisions. So it's a bit also to understand the groups of long-term.
Maybe there's paper jam. There's paper that is showing stuck there.
Assistant 24, page 24 now. Is it out?
Yes.
Go to page 24.
Okay.
Sorry. So then decisions.
Can't hear you.
You cannot hear me?
No, hear you now.
Okay. Maybe to say.
Not now.
Okay, so the investment decisions can be classified under two groups: long-term investment decision, then the second is short-term investment decision. The former are referred to as capital budgeting, and the latter management. So here I also try maybe to help to understand what is capital budgeting and what is working capital, because yeah, sometimes we are not familiar, like myself, with this language. So maybe to explain a bit. So capital budgeting is the process a business undertakes to evaluate potential major projects or investments. And working capital, it is the profit of the exercise when one subtracts current liabilities from current assets. So one is what you work in, another one is like the current from liabilities. And then current assets also include cash, accounts receivable, and inventory. So we to see what we have in stock. And current liabilities include payable, taxes, wages, and interest owed. On page 5, decision is how to the organization pay for the investment it takes. This determines the right-hand side of the balance sheet. It is also known as the capital structure decision. It involves choosing the best source of raising funds and deciding the optimal mix of various sources of finance, having regard to the relative cost of capital, degree of risk, and owner's control. So here also to know what are and then fixed assets such as buildings, vehicles, used assets, non-used assets, other fixed assets. But these things should are appearing in this balance sheet. What is it called? So you see that the two ways of comparison of financial decisions are taken and based on. Then page 26, sound financial management. Sound financial management requires careful tracking and prudent management of an organization's financial sources and cash flows. With good financial management, an organization can understand and control costs while at the same time generating income for the benefit of its stakeholders. So it helps improving the profitability of organization as we accompany to see how it is moving. Then also it provides economic stability, to see if the investments are well done, and encourages employees to save money, which helps them in personal financial planning. On page 27, the management comprises of planning, financial planning. So it is a decision. I mean, it is something designed by the organization in order to meet its goals. So, for example, if we need to build a convent, so we need to. So on one side we see the material that is needed: brick, cement, metal, iron sheets, whatever, windows. So we establish how much is to build this one. So the budgets are the first step in sound financial management. So because when we meet the two sides, so we are in a good position to present it to the sponsor. And then he sees if it is applicable, he may sponsor it, he may give the money. Yeah, but so it also should be on good and clear planned activities and recurrent budgets, also capital budgets. that is important that everything is established in a good and way. First, for our face between us, but also in face of stakeholders. On the forecast of income and expenditure for the next operating period. So it also helps the budget when we make the budget. For example, like we have like let us say a workshop, carpentry or mechanical. So we see what we want to do. So we put on side what can be the possible income and expenditures, and for the following year, whatever we are going to improve or to acquire, as the income and the expenses are based somehow on what was the expend or happened during the first year. So the reporting helps also in this aspect. And then the capital budgeting is a key investment. All organizations how it deals with investment in long-term assets such as buildings, equipment, investment decisions must be because they cannot. So once again, so what sometimes on the page investment of funds in a project where a large amount of money is needed should be based on the technical feasibility and financial stability. So you cannot just ask money or just for the sake of doing it. But
Can't hear you.
Oh. So I would say that in this regard to capital budgeting, so the budget couldn't just be be elaborated only for the sake of being elaborated, but it should be based on the aim of a technical feasibility. So is it possible to establish it, to make it feasible, or and also the financial. Is it possible that what we are going to ask, going to put in place, is it financial maybe by us? Is it or we need to look for sources elsewhere? Now, is it going to profit anyone of us, or maybe like maybe a school? Maybe we plan maybe for, let's say, 500 students, but we are going only to have 50. Now, is it feasible? So it has to be taken into account. On page 32, so then consider the various alternatives available, evaluate 2 or more projects, consider the cash flows for each option, evaluate cash flow based on time value for money. Present value of the cash inflows and the present value of cash outflows over a period of time. So it involves assessing the potential projects at hand and budgeting their projected cash flows. Once in place, the present value of these cash flows is ascertained and compared between each project. Then on page 33, still on financial decisions. This is the decision concerned with the sourcing of funds that are utilized for investment purposes. As organizations expand, they require growing amounts of cash to finance acquisitions of fixed assets. They also require cash to finance their growing working capital needs. So decisions that companies need to take regarding what proportion of equity and debt capital have to have in their capital structure. So this plays an important role, financing its assets, investment-related decisions, and shareholder value creation. Page 34, still on financial planning. So another key is where do we get funds? Funds can be sourced internally or externally. Internally sources are funds retained from profits or passes in previous years. Now, maybe also after maybe the COVID experience, we are becoming aware that sources, external sources, the resources are becoming or less and less available. So then, for example, maybe like maybe in our communities, sometimes from Europe, we were getting money to sponsor maybe our formation, let us say in one aspect, or for example, even now some of us are growing old in age, and the medical aid is not there. So then we need to be now also creative and to help. I mean, to work to get sources internally, maybe to find means. Yeah, for example, like for example ourselves. Now we're trying to work as we have our magazine, for instance. So it is a way of mission promotion, mission awareness, and also through that maybe what they animate people, and sometimes also the money they give a bit more, we can direct to the formation of our students. Yeah. So we need to be a bit creative and to be aware that the resourcing from outside is becoming less and less than in the past. Then finance decisions, external funds come at cost and can be sourced from lending institutions and the public through share issues. So no, 35, 35.
Okay.
Page 35. So, yeah. Yeah, so I think also in this aspect, you know that many NGOs or stakeholders or sponsors, they don't give it for free. Yeah, and also you can experience that maybe at the government level. Yeah? So they give money, but at the end they tax or they ask even more. So we have to pay more than we also to be aware of it. So that's why we need to look for means of internal sourcing of funds. Now, page 36. Consider the various sources of funds, compare the alternative cost of funds, and choose the most cost-effective sources. So it means that you are serious with your activity project, that the project activity meets its purpose and is worth investing. So when so we give the proper reporting, the funds are coming in. Even internally, if, for example, if you go to the hospital, if the medicine, the doctors look well for you, the medication, so the people come and also the resources help. Sourcing of funds. Page 37 system. So there is need to enhance local before fundraising in view of dwindling foreign donor funding. There is a lot of dependency on donor funds, and it is important to balance between donor funds and local resources. The biggest challenge is how to finance the existing deficits. So the finance all the existing deficits is to borrow money, yeah, and needing to pay interest both to the investors, often the investors. So, and then on page 38, At the heart of financial management is the concept of financial control. This describes a situation where the financial resources of an organization are being correctly and effectively used. Financial control occurs, systems and procedures are established to make sure that the financial resources of an organization are being properly handled. So the procedures, policies, and means by which an organization monitors the direction, allocation, and the usage of its financial resources. Then on page
39.
39, yeah, 39. Key components also of good financial management is an effective internal control structure system. With respect to financial management, this includes the safeguarding of assets, accurate and reliable financial recording keeping, compliance with internal policies, and funding requirements as separation of duties. So the process effected by an entity such as board of directors or management and other personnel designed to provide reasonable assurance that information is reliable, accurate, and timely. So very proper how things are going on. Then other potential risks faced by organizations is the theft of cash and assets, frauds, misuse of organizational resources, catastrophic occurrences of fire, third-party claims, unaccounted revenues, penalties and fees, corruption and procurement. Yeah, so everyone to be aware of this. That avoided now internal places. 941 is there are controls put in place by management to safeguard organizational resources. Controls ensure that there is completeness in the recording of the income and expenditures. Assets are safeguarded against misuse, loss, theft, extravagance, etc. So once again, the recording of incomes and expenditure is very important. So we have to underline it very well, and that we become example to even to our governments. Then reporting and accountability. Periodic report for internal and external use should be prepared on time. Flow statement, project financial report will be read together with projects. I think most of us, these reports can be done monthly, but I think most of the times is done quarterly, every quarter. Then at the end of the year, we bring all the thing together, and it becomes the balance sheet where it we chose the income and what was the cash flow and inflow of the current year. And also the narrative reported is important that when we are presenting the report, we know what we are talking about, and just not having a number and then mentioning something completely different. So that's why the good recording helps also a good narrative of the report. So as I said, either monthly or quarterly and annual. Then monitoring and evaluating. The key performance indicators are to be set, comparison of actual versus projections, and taking current corrective action. So it is a process that involves collecting and analyzing data to measure progress towards achieving specific goals. Actual and projected costs. Projected costs are estimated costs based on the previous period sales and expenses. Actual costs are the actual amounts spent during the period. And then to see, also helps to see if we are within or if we ever overspent. And taking corrective action is a verbal or written communication from the employer to the employee in correcting the problem or concern. Also can like a performance or conduct or accountability. Then another point important is the auditing. Auditing is an independent examination, is an independent examination of the books of account. Auditing adds credibility to project financial reports. Then there are on the next page say that there are two types of audits. There's internal and external audits. Internal audit is concerned with the efficiency of operations and adherence to policies. External audit is concerned with accountability and transparency. So we as bursars of our communities, of our institutes, or whatever area we are in, so we should be accountable anytime to our local superiors or our people of our institute or maybe the diocese to come in. And then external audits is maybe calling someone independent, not belonging maybe to any of these entities, but trustworthy, that comes and also helps to see if we are coherent to what we are supposed to do. So we are accountable if we are recording well, if we are giving good reporting, and if we are transparent and keeping everything in place. Now, interpretation of financial reports. This involves the analysis of financial information by financial managers for decision-making purposes. Financial reports are expected to assist project managers organization's project. So then on the 27 we have financial ratios. Financial ratios. So our analysis in the calculation and the comparison of ratios, which are derived from the information in an organization's financial statements. The level and historical trends of these ratios can be used to make inferences about a company's financial condition, its operations, and attractiveness as an investment project. So it is a quantitative method of gaining insight into a company's liquidity, operational efficiency, and profitability by studying its financial statement, such as the balance sheet and income statements. It can mark how a company is performing over time, while comparing a company to another within the semi-industry sector, as it may also be required by external parties. So, for example, if we have a workshop that is producing some, like a carpentry, if someone comes and then looks at the ratios, what our incomes costs, and if he compares, because if we are more expensive and we are not really investing, so then they won't invest with us. Then probability ratio is the gross versus net profit. Liquidity ratios is current assets ratio and quick ratio. There are investment ratio, return on investment, leverage, gearing ratios, debt ratios, assets, turnover ratios, stock and fixed assets, activity, example, collection period. This is, was maybe a bit more for companies than this point 48. Then, but the important is a sound financial accounting system. So it is important to keep books of accounts. So there is a need to keep all books of accounts and the supporting documents for transparency and accountability of funds. So as we saw before, the receipts, card sales, invoices, and also levels of authority. This should be established for authorization of expenses. So we cannot just each institution should have, for example, a committee through which the main expenses or maybe above a certain amount of money should be established and should be taken place only under the authorization expressed by this board. The accounting system, page 50, should consist of clear policies and procedures that describe how transactions are handled, authorized and recorded, how information moves through the organization, and how where accounting information stored for is retrieval. So those who authorize transactions and the one assigned to record the transactions. So there should be people, those who authorize the transactions and the ones assigned to record transactions. The disclosures of transactions or any other information related should follow its parameters, and information should be kept preferably in a safe place and made available for consultation. So not that everyone should go there, but so also you should keep, you should be aware of making backups of our accounting systems, because anytime we can lose data, and then if people come to check or for auditing, and then you don't have, so we are internally and externally. Many times, stations are required to account for funds that are handed to us with restrictions on their use. These are called restricted funds. The tracking and the reporting to transactions by funding source is generally referred to as a fund accounting, need for separate bank accountings. So one thing important is when the sponsor gives us money, I mean, helps to finance, is that to respect the intention of the donor or sponsors. And the restricted funds, it means that these funds should not be part of a current account. So for example, we have our communities, our convents, but we have a school next. So that the accounts of the school shouldn't be part of the community's account. So it should be run in a different bank account. Open to that purpose. Then, competence of the accounting, proper internal control environment, timely financial, effective internal control system. So this way already before, so each organization has to have these policies, procedures. So then the staff competence, not everyone is capable of accounting. So person has to be specialized and be accountable for what he does, and so then also the internal controls to accompany, to monitor, yeah, all these things. And then on page 53, I think, yeah, the stewardship of financial resources, competitive quality service, involvement, ownership, and participation of stakeholders, a conducive working environment. Then on page 54, the strong support and commitment from top management. Unity should not condemn. Financial controls, proper authorization, monitoring and control of operations. Still, the regular production of financial statements and their subsequent review by management are critical of elements of good financial management. So it is not just important, it's not just enough that the account makes the financial reports, but also the management has to accompany, to monitor and control if everything has been done accordingly. Then, in summary, there are 7 principles of best practice or financial management. So we have then consistency, accountability, transparency, reliability, integrity, accounting standards. Then it said consistency is the financial policies and systems of the organization must be consistent over time. This promotes efficient operations and transparency, especially in financial reporting. But to be constant in the policy is not saying one thing today and another thing today. Accountability, the organization project must explain how it has its resources and what it has achieved as a result of all stakeholders, including the beneficiaries. But it's not just a matter of getting the money and then making expenses or expending it, but we need to explain how the resources were used. You know, also to favor things concept. Then transparency on page 59. The organization must be open about its work, making information about its activities and plans available to relevant stakeholders. This includes preparing accurate, complete, and timely financial reports and making them accessible to stakeholders, including beneficiaries. So it's a bit, because you know that I think more than in the past, our sponsors are very strict and anytime they can come and they want to look at information. Then on page an organization's expenditure must be kept in balance with income expense, both at the operational and the strategic levels. The ability is a measure of the NGO's financial continuity and so then if you see that the expenditures are more than at personal level, individuals in the project must operate with honesty and propriety. For example, managers and board members will lead by example in following policy and procedures and declare any interest that might conflict with their official duties. Stewardship and organization 62 organization must take good care of the resources it is entrusted with and make sure that they are used for the purpose intended. This is known as stewardship. The governing body, for example, the Board of Trustees, has responsibility for this. Page 63, accounting standards. The system for keeping financial records and documentation must observe internationally accepted accounting standards and principles. Any accountant from anywhere around the world should be able to understand the organization system for keeping financial records. So now, as we are becoming the global entity in the world, so any person anywhere should be able to get to read what is going on in our institution. And I think marks the end of the exposition.
Okay. we're not sure if you have any questions or anything needs to comments or anything needs to have clarifications. You can have it now. Just need to unmute yourself, raise your hands, or you just raise your questions if you like. Sister Pascaline? Oh. If you have any questions, you can just unmute yourself. If there's no questions or comments, okay, thank you, Sister Edith. Yes, on behalf of the conference and all the participants, we would like just to thank Brother Paulos for giving us also this information on financial management overview. Just one announcement, next workshop will be on the 4th of April, which is next Tuesday. And the following one will be on the 11th of April. And we use the same link like yesterday. So thanks so much. And if you continue to have any questions, you can always email us, lcclsa@mweb.co.za. And once again, thanks for joining us today. Just for closing, we would just say the glory be, and we wish you another great afternoon after this workshop. Thanks so much. In the name of the Father, and of the Son, and of the Holy Spirit. Amen. Glory be to the Father, and to the Son, and to the Holy Spirit, as it was in the beginning, is now, and ever shall be, world without end. Amen. In the name of the Father, and of the Son, and of the Holy Spirit. Amen. And enjoy the rest of your afternoon, everyone. And thanks, Brother Paulos again. May God
thank you.
God bless you all. Thanks a lot. And we'll send out the recording and the material to you via email. Thanks once again. God bless.
Thank you.
Thank you. God bless. God bless.
Yes.